You're watching gold do something it hasn't done in over 40 years. And I'm not talking about the price hitting $4,300. I'm talking about what's happening beneath the surface that almost nobody is paying attention to. Because while everyone's focused on the headlines, there's a signal flashing in the gold market right now that historically only appears right before massive moves, the kind of moves that change everything. Let me show you what I'm seeing. Right now, as I'm recording this, gold is trading above $4,300 an ounce. That's not the shocking part. What's shocking is how it's behaving at this level. Most people think when an asset hits all-time highs, it gets volatile. It swings wildly. Traders take profits. The price pulls back. That's normal market behavior. But gold is doing the opposite. It's consolidating. It's holding steady. It's building a base at $4,300 like it's preparing for something much bigger. And here's why that matters. When you see an asset hit record highs and then refuse to pull back, that's not weakness. That's strength. That's institutional accumulation. That's smart money positioning for the next leg up. And the data confirms it. Morgan Stanley just came out with a forecast that has gold reaching $4,500 by mid-2026. JP Morgan is even more aggressive, calling for average prices above $4,600 in Q2 and potentially breaking $5,000. These aren't fringe analysts making wild predictions. These are the biggest banks in the world telling their clients to prepare for gold to go significantly higher from already record levels. But here's what they're not telling you. Here's the signal nobody saw coming. Central banks are buying gold at a pace we haven't seen since 1950. Not 2008. Not 2011. 1950. We're talking about 75 years. And it's not just the usual suspects. It's not just China and Russia. Poland just added to their reserves. Singapore's been quietly accumulating. Turkey's buying. India's buying. Even countries that have historically been dollar loyalists are diversifying into gold at record speed. Why? What do they know that the average investor doesn't? Let me paint you a picture. In the first 3 quarters of this year alone, central banks purchased over 800 tons of gold. That's more than the entire annual production of some major mining countries. And here's the kicker. They're not slowing down. If anything, they're accelerating. The World Gold Council data shows that central bank demand in Q3 was up 14% compared to the same period last year. And Q4. Early indications suggest it could be even higher. Now you might be thinking, okay, central banks are buying gold. They always buy gold. What's the big deal? Here's the big deal. They're not just buying gold. They're repatriating it. They're physically moving gold out of vaults in London and New York and bringing it home. Germany did it. Austria did it. The Netherlands did it. And now we're seeing a new wave of countries doing the same thing. Why would they do that? Why would you go through the expense and logistical nightmare of physically moving hundreds of tons of gold across the world unless you were preparing for something? Unless you were worried about something? The answer is trust, or more accurately, the lack of it. See, for decades, the global financial system has operated on trust. Trust in the dollar, trust in U.S. Treasury bonds, trust that the system would remain stable. But that trust is eroding, and gold is the ultimate hedge against that erosion. Let me give you a specific example. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. And what happened? Gold went from $35 an ounce to over $800 by 1980. That's a 2,200% increase in less than a decade. Why? Because the world lost trust in the dollar's backing. They realized it was just paper, and they rushed into the only asset that couldn't be printed, gold. Now, I'm not saying we're going to see a 2,200% increase from here, but I am saying we're seeing similar dynamics. The U.S. national debt just crossed $36 trillion. That's trillion with a T. The deficit is running over $2 trillion a year. The Federal Reserve's balance sheet, even after some reduction, is still sitting at over $7 trillion. And every time there's a crisis, what do? They print more money. They expand the balance sheet. They devalue the currency. And central banks see this. They're not stupid. They're run by some of the smartest economists and financial minds in the world. And they're looking at the trajectory of U.S. fiscal policy and saying, we need to diversify. We need insurance. We need gold. But here's where it gets really interesting. It's not just central banks. The COMEX, the major futures exchange where gold is traded, is showing something unusual. Open interest, the number of outstanding futures contracts, has been climbing even as the price hits new highs. Normally, when prices surge, open interest drops because traders close positions and take profits. But that's not happening. Open interest is rising, which means new money is coming in. New positions are being established. And that suggests this move is far from over. Let me break down what's happening in the physical market, because this is where the real story is. The London Bullion Market Association, the LBMA, which handles the majority of global gold trading, has seen a significant tightening in physical supply. Premiums for physical gold over the paper price have been widening. In some markets, you're paying 3% to 5% above spot just to get your hands on actual metal. That's not normal. That's a supply squeeze. And it's not just gold bars. Gold coins from major mints, the US Mint, the Royal Canadian Mint, the Perth Mint, they're all reporting strong demand. Wait times for certain products have extended. Premiums have increased. This is retail demand, everyday people, recognizing something is happening and wanting to own physical gold. Now, let me connect some dots for you. Silver, often called poor man's gold, has more than doubled this year. It went from around $30 an ounce at the start of the year to hitting record highs above $60. Why does that matter? Because silver often leads gold. When you see silver making explosive moves, gold typically follows. And the ratio between gold and silver, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. That's historically bullish for both metals, but especially for gold. Here's another piece of the puzzle. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, have been openly discussing alternatives to the dollar for international trade. They're talking about a gold-backed currency. They're talking about settling trade in local currencies. They're talking about reducing dollar dependence. And whether or not they actually launch a gold-backed currency, the fact that they're even discussing it sends a signal to the market. It says the dollar's dominance is being challenged, and when the dollar's dominance is challenged, gold benefits. Let me give you a real-world example of what this looks like. China has been accumulating gold for years, but they don't report their full holdings. Analysts estimate China's actual gold reserves could be double or triple what they officially report. Why would they hide it? Because if the market knew the true extent of their accumulation, it would drive the price up before they finished buying. They're playing the long game. They're positioning for a world where the dollar is less dominant and gold is more important. And it's not just nation-states. Institutional investors are piling in. Gold ETFs, exchange-traded funds that hold physical gold, have seen inflows accelerate. Hedge funds are increasing their long positions. Family offices, the investment vehicles for ultra-wealthy families, are allocating more to gold. These are sophisticated investors with access to the best research and analysis in the world, and they're buying gold at record prices because they believe it's going higher. Now, here's where this gets personal. If you're sitting on retirement savings, if you have a 401k or an IRA, you need to understand what's happening. Because the signal gold is sending right now isn't just about the price of gold. It's about the value of everything else. It's about the purchasing power of your dollars. It's about whether your savings will maintain their value in the years ahead. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, how the process works, what the costs are. Worth checking out if that's relevant to your situation. Anyway, back to this signal. Let me tell you about 2008. When the financial crisis hit, gold was trading around $800 an ounce. Everyone thought it would crash along with everything else. But it didn't. It consolidated for a few months, and then it took off. By 2011, it had hit $1,900. Why? Because people lost faith in the financial system. They saw banks collapse. They saw governments bail out institutions with printed money, and they rushed into gold. Now, I'm not predicting another 2008-style crisis, but I am saying the conditions that drive people into gold, currency debasement, loss of trust, geopolitical instability, those conditions are present right now, and they're intensifying. Look at what's happening geopolitically. The war in Ukraine is still ongoing. Tensions between the US and China are escalating. The Middle East remains unstable. Trade wars are flaring up. And every one of these conflicts reinforces the case for gold. Because gold doesn't have counterparty risk. It doesn't depend on any government or institution. It just is. And in times of uncertainty, that's incredibly valuable. Here's another angle most people miss. Gold mining production has been flat to declining for years. The easy gold has been mined. New discoveries are rare, and it takes 10 to 15 years to bring a new mine online. So even if gold prices stay elevated, which incentivizes more exploration and production, the supply response is slow. Meanwhile, demand from central banks, institutions, and retail investors is surging. That's a classic supply-demand imbalance, and it's bullish. Let me give you some specific numbers. Global gold mine production in 2024 was around 3,000 tons. Central banks alone bought over 800 tons. That's more than a quarter of total production. Add in jewelry demand, which is still strong in countries like India and China. Add in industrial demand for electronics and technology. Add in investment demand from ETFs and retail buyers, and you quickly realize the market is tight. Very tight. And here's what happens in tight markets. Prices go up, but not in a straight line. They consolidate, they build bases, they shake out weak hands, and then they explode higher. That's what we're seeing right now at $4,300. This isn't a top, this is a launching pad. Now let me address the skeptics, because I know what some of you are thinking. Gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. Why would I own it? Here's why. Gold is insurance. It's wealth preservation. It's a hedge against the debasement of fiat currency. And in an environment where governments are running massive deficits, where central banks are trapped between inflation and recession, where geopolitical risks are rising, that insurance is more valuable than ever. Think about it this way. If you own a house, you pay for homeowner's insurance. You hope you never need it, but you're glad it's there. Gold is the same thing. It's insurance for your financial life. And right now, the premiums for that insurance, the price of gold, are rising because the risks are rising. Let me tell you about a guy I know. He's a retired engineer, mid-60s, spent his whole career saving diligently, had a nice nest egg in his 401k, mostly stocks and bonds. In 2020, when COVID hit and the Fed started printing trillions, he got nervous. He didn't trust what was happening, so he moved 20% of his retirement into a gold IRA. His friends thought he was crazy. Gold was around $1,900 at the time. They said he was buying at the top. Fast forward to today, gold's at $4,300. That 20% allocation has more than doubled, and it's provided stability while the stock market has been volatile. He sleeps better at night knowing he has that insurance. That's the power of gold. It's not about getting rich quick. It's about protecting what you've already built. It's about making sure your purchasing power doesn't erode. It's about having a portion of your wealth in something that can't be printed, can't be devalued, and has held value for thousands of years. Now, let's talk about what happens next. Because the signal gold is sending right now, this consolidation at record highs, this institutional accumulation, this central bank buying spree, it's pointing to one thing: higher prices, significantly higher prices. JP Morgan's forecast of $5,000 gold isn't some pie-in-the-sky prediction. It's based on supply-demand fundamentals. It's based on central bank buying continuing. It's based on the dollar weakening as U.S. fiscal policy becomes increasingly unsustainable. And it's based on geopolitical risks remaining elevated. But here's what could push gold even higher than $5,000. A real crisis, a debt crisis, a currency crisis, a geopolitical shock. Any of these events could send gold parabolic. We saw it in the 1970s. We saw it in 2008, 2011, and we could see it again. Let me give you a scenario. Imagine the U.S. debt continues to grow at its current pace. Imagine interest payments on that debt become the largest line item in the federal budget, which they're on track to become. Imagine foreign buyers of U.S. treasuries, countries like China and Japan, start reducing their holdings. What happens? The Fed has to step in and buy more treasuries. They have to expand the balance sheet. They have to print more money. And what happens to gold when the Fed prints money? It goes up. Or imagine a geopolitical shock, a major conflict in the Middle East that disrupts oil supplies, a confrontation between the U.S. and China over Taiwan, a collapse of a major financial institution. Any of these events would send investors rushing into safe havens, and gold is the ultimate safe haven. Now, I'm not fear-mongering. I'm not saying these things will definitely happen, but I am saying the probability of these events is higher than most people think, and the market is pricing that in. That's what this signal is telling us. Here's another piece of evidence. The gold to S&P 500 ratio, which measures how many ounces of gold it takes to buy the S&P 500 index, has been rising. That means gold is outperforming stocks. And historically, when this ratio rises, it continues to rise for years. We saw it in the 1970s. We saw it in the 2000s. And we're seeing it again now. What does that mean for you? It means if you're overweight stocks and underweight gold, you're taking on more risk than you might realize. Because if we're entering a period where gold outperforms stocks, and the data suggests we are, then having zero exposure to gold is a bet against history. Let me tell you about another historical parallel. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's dollars. But here's the thing. Gold didn't just hit $850 and stop. It spiked to $850 in a matter of weeks as investors panicked about inflation and the dollar. It was a blow-off top, and then it crashed. But before it crashed, it went parabolic. Now, I'm not saying we're going to see a blow-off top at $4,300. But I am saying the conditions that create blow-off tops, loss of confidence in fiat currency, geopolitical instability, central bank money printing, those conditions are present. And if they intensify, we could see gold move much faster and much higher than anyone expects. Here's what the smart money is doing. They're not trying to time the top. They're not trying to predict the exact peak. They're accumulating. They're building positions. They're treating gold as a long-term strategic holding, not a short-term trade, because they understand that in an environment of currency debasement and geopolitical risk, gold is one of the few assets that will maintain its purchasing power. And it's not just about the price. It's about what gold represents. It represents freedom from the financial system. It represents independence from government policy. It represents a store of value that has survived empires, wars, and economic collapses. That's why central banks hold it. That's why billionaires hold it. And that's why you should consider holding it. Now let me address the practical side. How much gold should you own? There's no one-size-fits-all answer, but many financial advisors suggest 5% to 10% of your portfolio in precious metals. Some go higher, especially in uncertain times. The key is to have enough that it makes a difference if gold goes up, but not so much that you're overly concentrated in one asset. And how should you own it? There are several options. Physical gold, bars, and coins gives you direct ownership, but requires secure storage. Gold ETFs offer liquidity and convenience, but come with counterparty risk. Gold mining stocks provide leverage to the gold price, but also come with company-specific risks. And gold IRAs allow you to hold physical gold in a tax-advantaged retirement account. Each option has pros and cons. The important thing is to do your research, understand what you're buying, and make sure it fits your overall financial plan. Here's what I want you to take away from this. Gold is sending a signal right now that we haven't seen in decades. It's consolidating at record highs. Central banks are buying at a pace not seen since 1950. Institutional investors are accumulating. Physical supply is tightening. And major banks are forecasting significantly higher prices. This isn't hype. This isn't speculation. This is data. This is what's actually happening in the market right now. And if history is any guide, when gold sends this kind of signal, it's usually right before a major move higher. The question isn't whether gold will go higher. The question is how much higher and how fast. And while nobody can predict the future with certainty, The evidence suggests we're in the early stages of a significant bull market in gold, not the late stages, the early stages. So, what do you do with this information? That's up to you, but I'll tell you what I'm doing. I'm paying attention. I'm watching the data. I'm monitoring central bank purchases. I'm tracking physical supply, and I'm making sure I have exposure to gold in my portfolio. Because when an asset that's been around for 5,000 years starts sending signals like this, it's worth listening. The signal is clear. The question is, are you paying attention? Because the investors who recognize these signals early, who position themselves before the crowd, those are the ones who benefit the most. And right now, we're still early. Gold at $4,300 might seem expensive, but if it's going to $5,000, $6,000, or higher, then $4,300 will look like a bargain in hindsight. This is the signal nobody saw coming. Gold consolidating at record highs, central banks accumulating at historic rates, institutional money flowing in, physical supply tightening, and major banks calling for significantly higher prices, all while most investors are still underweight or have zero exposure. The opportunity is now. The signal is flashing. And history suggests that when gold sends this kind of signal, you don't want to ignore it.